The silver market is frozen tonight, but before futures light back up Sunday evening, one decision somewhere on the planet could slam this metal violently higher or lower before most investors even wake up. Monday, the exchanges are quiet for now. Silver is paused. Yet between this moment and the electronic reopen Sunday night, a major headline out of the Middle East, Washington, or a key shipping corridor, could redraw the entire setup for next week. Most television analysts will still be offline while it unfolds, and that is why you need the roadmap before the first candle appears. Once trading resumes, hesitation could already be too late. Silver ended Friday near $75 an ounce after losing ground into the close. Futures opened the day stronger, drifted lower during the morning session, and spent the rest of the week trapped inside a surprisingly narrow range. On the surface, that sounds calm. It is not calm. It is tension disguised as stability. A market barely moving ahead of several unresolved global events is not relaxing. It is compressing like a spring under pressure. And when that pressure finally releases, the move could be brutal in either direction. We are talking about a potential 5 to 10% reaction in a single session, depending on what develops over the weekend. So what exactly are traders watching? And why are experienced silver investors treating this weekend differently from every other weekend this year? The first issue is the ongoing negotiation involving Iran and the United States. Officials on both sides hinted this week that discussions had improved, but no formal breakthrough has been announced. Reports out of the region suggested meetings involving diplomats and Pakistani intermediaries continued behind closed doors. Earlier in the week, comments from President Trump, implying negotiations were approaching a final stage, pushed crude oil sharply downward in one trading day. Energy traders immediately responded because lower oil changes the entire inflation outlook. At the same time, shipping data showed multiple tankers successfully moving through the Strait of Hormuz during one of the busiest transit periods since the conflict intensified months ago. That mattered because global markets have been terrified of supply disruptions. But by Friday, optimism faded again. Oil reversed upward as investors questioned whether a genuine agreement was actually close or whether markets had overreacted to political messaging. Silver surrendered most of its midweek gains almost immediately, and now the entire setup comes down to three possible paths. Path number one is a confirmed agreement sometime before futures reopen Sunday night. If that happens, the market response could be explosive. Why? Because traders would no longer be pricing rumors. They would be pricing a real shift in the inflation narrative. If oil suddenly falls toward $90 a barrel, expectations around future consumer inflation change immediately. The Federal Reserve would face less pressure to keep rates elevated, bond yields could retreat. The dollar could weaken, and silver, which has struggled under the weight of high real yields, suddenly gets breathing room again. Remember what happened earlier this month, when reports suggested progress toward a possible framework? Silver surged rapidly in one morning session. Gold pushed higher alongside it, but this weekend could be bigger because confirmation hits differently than speculation. Markets respond far more aggressively when uncertainty disappears. In that scenario, silver reopening above $80 becomes realistic. The previous highs from earlier this month quickly return into focus. Rate expectations for the rest of the year would also change dramatically. Right now, traders still expect the Federal Reserve to remain extremely cautious because inflation pressures remain stubborn, but lower energy costs alter that calculation. A world with oil near $88 produces a completely different Federal Reserve outlook than a world with oil stuck above 100. That difference matters enormously for precious metals. Now let us talk about the scenario many investors still underestimate. What if negotiations collapse? What if another disagreement surfaces this weekend? What if public statements from either side destroy confidence all over? Again, then oil could rip back above $110 before Tuesday even arrives. And if that happens, silver faces immediate pressure, despite its long-term bullish story. Why would silver weaken in a crisis involving inflation? Because elevated oil pushes inflation expectations upward. Again, rising inflation pressures force the Federal Reserve to stay restrictive. Higher rates support bond yields. Stronger yields create competition against non-yielding assets like silver. That is the painful contradiction many newer investors still do not fully understand. Under that bearish weekend scenario, support near $70 gets tested again. Markets would likely begin pricing a stronger possibility of additional tightening from the Federal Reserve before year-end. And the deeper this inflation shock stretches, the harder it becomes for silver to break above resistance in a lasting way. But there is also a third possibility, and honestly, it may still be the most likely. Nothing definitive happens. No formal agreement, no total collapse, just more uncertainty, more waiting, more contradictory headlines. In that situation, silver probably reopens close to where it finished Friday, while traders shift attention toward incoming economic data later in the week. Upcoming GDP numbers and unemployment claims will become the next major catalysts because they help answer one question haunting the entire market right now. Is the economy slowing while inflation remains elevated? Because if the answer is yes, then the United States drifts deeper into stagflation territory, and stagflation creates a strange prison around silver prices. Here's why that matters so much. Silver effectively runs on two separate drivers. Most people only understand one of them. The first driver is monetary demand. This is the traditional precious metal story. Investors buy silver as protection against currency weakness, falling purchasing power, and loose monetary policy. Lower real yields and a softer dollar usually help this side of the market tremendously. The second driver is industrial demand. Silver remains critical for solar technology, electric vehicles, high-speed communication systems, advanced electronics, artificial intelligence infrastructure, and countless industrial processes requiring exceptional conductivity. In strong economic environments with supportive monetary conditions, both demand engines push in the same direction simultaneously. And when both forces align, silver can move with shocking speed. That combination helped propel prices from the low 30s in early 2025 to dramatically higher levels within a year. Investors witnessed what happens when monetary demand and industrial demand reinforce each other together instead of fighting each other. But the geopolitical conflict disrupted the monetary side of that equation. Once energy prices exploded higher after shipping threats intensified around the Strait of Hormuz, inflation accelerated again. Higher inflation forced markets to abandon expectations for aggressive rate cuts. The Federal Reserve became trapped. Real yields climbed. Suddenly, the monetary environment supporting silver flipped negative. So while industrial demand remained alive, the financial environment surrounding precious metals turned hostile. Every attempted breakout toward $80 encountered resistance from rising yields and tighter monetary expectations. That does not mean the industrial story disappeared. Far from it. Global supply deficits still exist. Demand tied to green energy and advanced manufacturing continues building underneath the surface. Mine production has struggled to expand fast enough. Large portions of global refined supply remain constrained by export restrictions and logistical bottlenecks. Physical availability inside certain futures markets remains surprisingly thin compared to the paper exposure layered on top of it. In other words, the long-term structure supporting silver has not vanished. It has simply been partially muted by inflation-driven monetary pressure. That is why this weekend matters so much. A credible diplomatic breakthrough could restart the monetary side of silver's story almost instantly. Lower oil prices would cool inflation fears. Cooling inflation fears would weaken the case for restrictive policy. Easier financial conditions would finally allow both engines inside the silver market to accelerate together again. And if both engines restart simultaneously in a market already facing structural supply shortages, institutional price targets suddenly stop looking outrageous. This is where the mathematics behind some of the aggressive targets originates. If gold advances further, while silver narrows the ratio gap that historically seen during precious metals bull runs, triple-digit silver prices stop sounding impossible, and that does not guarantee those numbers arrive tomorrow. But it explains why long-term institutional forecasts remain elevated despite all the recent volatility. Now, there is another important data point from this week that almost nobody discussed properly. Consumer inflation expectations from the University of Michigan survey eased modestly in preliminary readings. That detail matters because inflation expectations influence spending behavior, wage demands, and Federal Reserve psychology. When consumers expect inflation to remain high indefinitely, policymakers become more aggressive trying to contain it. But if expectations stabilize or begin cooling, markets start believing inflation pressures may eventually moderate without additional severe tightening. That subtle shift can influence bonds, currencies, and precious metals simultaneously. So traders heading into Monday are really watching two variables above everything else. First, whether negotiations surrounding the conflict improve or deteriorate over the weekend. Second, whether inflation expectations continue easing or begin heating up again. Those two forces together could shape the opening direction for silver far more than any other headline. And stepping back from the weekend noise for a moment, here's the broader picture every silver holder should understand. Gold prices remain historically elevated. Several major financial institutions continue forecasting higher targets, moving forward. If even conservative projections play out while silver compresses its ratio relative to gold, the implied silver valuation climbs sharply. That is the larger framework behind the bullish case. It is not random excitement. It is a calculation involving monetary policy, supply shortages, industrial demand, and historical ratio behavior. The issue is timing. And timing right now depends heavily on whether energy-driven inflation continues dominating financial markets. Later this week, additional economic reports, including GDP growth and labor data, will add another layer of pressure. Weak growth combined with persistent inflation creates the exact stagflation environment and central banks fear most. In that environment, the Federal Reserve faces impossible trade-offs: support the economy too aggressively and inflation worsens, stay restrictive too long and economic weakness deepens. Then comes the next Federal Reserve meeting and updated projections. Investors will study every sentence, searching for clues. Are policymakers leaning toward future cuts, or are more officials considering tighter policy because inflation remains sticky? That distinction could determine whether silver finally clears resistance or remains trapped beneath it through the summer months. So let me leave you with this. By the time futures reopen Sunday night, silver could be preparing for a violent move in either direction, based on developments completely outside ordinary investors' control. But understanding the structure behind those moves changes everything. You are not watching a random metal bouncing around a chart. You are watching an asset tied simultaneously to monetary policy, industrial expansion, energy markets, geopolitical risk, and physical supply stress. You are watching a market carrying years of accumulated deficits while institutional forecasts for gold continue rising higher. And perhaps most importantly, you're watching a market where one major obstacle still stands in the way of both bullish engines firing together at full force. That obstacle is the inflation shock tied to energy prices and geopolitical instability. If that obstacle weakens, the entire silver narrative changes rapidly. Every conflict eventually reaches an endpoint. Every energy panic eventually cools, and if diplomacy finally breaks through, the monetary side of silver's story could reignite much faster than most investors expect. That is why this weekend matters. That is why experienced traders are watching every headline, and that is why the futures open Sunday night could become one of the most important openings of the year for precious metals investors. Watch the oil market carefully, watch geopolitical developments closely, watch incoming economic data, and above all, understand the bigger framework, instead of reacting emotionally to every candle flashing across your screen. If this breakdown helped you prepare for the week ahead, hit like and subscribe to Winds of Thought for more real-time market analysis and deeper macroeconomic insights. Share this video with someone holding silver right now, because the next move could arrive before most people even understand what caused it. Stay sharp, stay informed, and be ready before the opening bell returns Sunday night.